Imagine a world where average Americans could diversify their retirement portfolios with private equity, real estate, and even cryptocurrencies, assets traditionally reserved for the ultra-wealthy. President Donald Trump took a significant step toward making this vision a reality by signing an executive order aimed at opening up alternative assets to retirement savers. This move could potentially democratize access to high-return investment opportunities. But here's where it gets controversial. On August 2025, Trump issued an executive order directing the Labor Department to collaborate with the Treasury Department and the Securities and Exchange Commission. Their task? To identify and modify regulations that would allow alternative asset managers to integrate their offerings into employer-sponsored retirement plans. With over $12 trillion in retirement funds, including $9 trillion in 401ks, these managers see a vast untapped market ripe for investment. Alternative asset management firms, such as private equity and real estate funds, have long been the domain of the ultra-rich. However, they are now eyeing the retirement savings of ordinary Americans. For instance, Apollo Global Management partnered with Empower, the second-largest retirement plan provider, to offer access to private market investments. Similarly, BlackRock joined forces with Great Gray Trust to provide similar opportunities. As of now, alternative asset managers oversee more than $33 trillion, according to J.P. Morgan Research. This executive order seeks to address the legal barriers that have historically prevented alternative asset managers from participating in defined contribution plans, which typically focus on stocks and bonds. The influx of capital into private market investments has slowed significantly since 2021, dropping nearly 30% by 2024, according to a May report from PitchBook. This slowdown affects various sectors, from venture capital to real estate. Private equity, a crucial component of the private asset market, involves acquiring companies, improving their performance, and selling them at a profit. However, its performance can vary widely. Only 2 years between 2007 and 2023 saw private equity returns exceed the S&P 500 by at least 3%, as reported by PitchBook. Another challenge is the illiquidity of private market assets. These investments are often tied up in long-term projects lasting more than a decade, making it difficult for investors to withdraw their funds quickly in case of emergencies. David Robinson, a finance professor at Duke University, illustrated this point. If you're unhappy with a mutual fund, you can sell your shares immediately. In contrast, voting with your feet in the private market is much more constrained. Additionally, the Employee Retirement Income Security Act of 1974 mandates that employer-sponsored retirement plans prioritize worker interests and maintain diversified portfolios. This requirement has hindered ordinary Americans from investing in alternative assets, which often come with higher risks, fees, and less transparency. Despite these challenges, Colleen Medill, a law professor at the University of Nebraska at Lincoln, believes that Trump's order could be a game-changer. By facilitating the inclusion of alternative investment options in defined contribution retirement plans, it could revolutionize how Americans save for retirement. But what do you think? Would you consider investing your retirement funds in private equity or real estate? Or do you believe the risks outweigh the potential benefits? Share your thoughts in the comments.